Happy Tuesday, everybody. Welcome to Heresy Financial. My name is Joseph Brown, and today we're going to go over a little bit of a market update because a couple crazy things have happened since I last spoke to you on Friday was my last market update here. So what we have up in front of us right here is the gold chart. And so I just want to zoom in here and show you this big red candlestick that was Friday. And that was the big sell-off that we had in gold. I said I think that was a good thing because it stopped at the support, the historical support from before. And then Monday, really a little bit, didn't really do much. And then today it's taken off. So we're going to dive into why that is happening. And then looking at the S&P 500 and the other major market indices and looking at why it's selling off today after it had a big rally yesterday. Let's dive in. Okay, so first up on the docket as to why the market has been acting the way it has, the central banks around the world announced a emergency G7 meeting to get together and figure out, hey, what's going on and what should our response be. Over the weekend, the Bank of Japan announced that they were going to be doing some additional monetary easing to try and, ease the economic pain that Asia is feeling right now. And on that, the markets rallied pretty good on Monday because everybody basically expected the Federal Reserve was going to fall in line. The market had already priced in the Federal Reserve basically doing an emergency rate cut, an inter-meeting rate cut, which they very rarely ever do. And so the market had priced that in, and the Federal Reserve, they never disappoint the market. If the market expects something, they really usually deliver on that. And mostly that's just due to the fact that the market has figured out how the Federal Reserve acts in certain situations. And in this situation, they pretty much knew that's what the Fed was going to do. The problem with this is, there's two big problems with this, which is why we're seeing a sell-off today, why the Federal Reserve action, didn't actually work. Number one, the fact is that the needle that's pricking all these asset bubbles, it's a big needle. It's the coronavirus, right? It's shutting down the world's major supplier of pretty much everything. 25% of everything is made in China. And so they've been shut down for months. And so, easier debt is not going to fix a broken supply chain. So that's number one. And number two, the second and third order effects from something like the coronavirus, people not traveling, people not shopping in the same way that they do, events being canceled, major local economic impacts. If there's a big conference with, a couple hundred or even a couple thousand people, if that gets canceled or postponed, that local economy is not going to have the same people, flying in, ordering, food at their restaurants, staying in the hotels, taking local transportation. And so there are tons of effects from this, from, things going virtual instead of local. And so lowering rates doesn't have an impact on, has hardly any impact on things like that. And so this, I was going to try and put out a video yesterday about this. I apologize. I was not able to because I was going to tell you guys, hey, this is a buy the rumor, sell the fact type of situation because markets are rallying on this, and as soon as it actually happens, it's already going to be priced in, and it's not addressing any of the major concerns. And so I anticipated that this would happen today, that we'd have a market sell-off as soon as the Federal Reserve announced they were cutting rates. They did by 50 basis points. That's 0.5%. And if we look at the chart here, pretty much right here, as soon as they announced they were cutting rates, there was a pop, and then boom, we've just been selling off since then. And if you look compared to yesterday, we are currently sitting right at that 200-day moving average for the S&P 500. So we'll see if we break support there. For the Dow, though, yesterday we never even got above it. And then for the Russell 2000, same thing, we never even got close to it. And so if you look at the major indices, and especially the Russell 2000, which I've said before, that's closer to home. Those are the smaller businesses, so that's a better indicator of how our American economy is doing, and the reaction to that. We can see that there's a much harder hit there. Now, I also said on Friday that gold was a buy the dip. I didn't think that about the markets, just the regular American equity markets, but gold stocks and physical gold, I did think that was a buy the dip opportunity that I told you guys about on Friday. I bought gold stocks as well, and so you can see here that yes, indeed, the same forces that have been driving gold higher over the last couple of years. Basically, it's an inverse of the money supply because gold really doesn't change in value. It's just basically, if they're pumping more fake money into the economy, then, you're going to have to, there's the same amount of gold pretty much. And so in order to represent the same amount of gold, you're going to need more dollars. And so for something that doesn't really change in value that much, something that's pretty stable, something that doesn't have, earnings or balance sheets or interest, that's where you have, the price action is going to be determined by monetary policy. For the most part here. So that's why you can see we had a sell-off just because in a illiquidity event, everything gets sold, right? In 2008, gold went down about 30% from the high to the low during 2008 when, everybody needed liquidity fast. They're selling anything they can. But from the bottom, from 2008 up until the top in 2011, it rallied something around like 260%. And so in liquidity events, gold's going to get sold off. And so that's what was happening here. People needed to sell just because they needed to sell everything was getting sold. But ultimately, the driving forces are still bullish for gold. And today alone, if we look at the GDX, which is gold mining stocks, it's up around 7.5% right now as we speak. So looks like at least so far that was a good call. Yesterday, if you follow me on Twitter, I'm pretty much every single day, all throughout the day, giving some sort of market updates, market commentary. So if you want something live in the moment, kind of as you go through the day, that's more frequent than my YouTube videos, you can follow me there on Twitter. But yesterday was a great day to throw on a little hedge onto the market here. And so we'll see what happens. So those are the driving factors that the Federal Reserve, they came out and they announced, hey, we're doing a rate cut, an emergency rate cut here, and didn't work, doesn't address the problems. And the biggest thing is that the coronavirus really isn't the problem. If we had a healthy global economy that wasn't built on record, unprecedented amounts of debt and fake money that's not founded on anything, just founded on debt, it's just, paper and digits, and people actually had savings and savers were rewarded and borrowers were punished in a sound money system. That's the way it's always worked historically. In a system like that, we could survive something like a pandemic pretty easily. Yes, there would be pain and yes, there would be hardship, but it's not going to collapse the global financial system. You have a couple of months or a couple of quarters of, figuring out how to deal with your supply chain issues. You don't have companies by the dozens or potentially hundreds, or how bad this gets, maybe even by the thousands, filing for bankruptcy and going out of business because everybody relies on easy credit to be able to do business. Now, the other thing that happened last night was the Federal Reserve. They participated. They gave it was like $100 billion in the repo market, and it was oversubscribed by like $8 billion. And so that's not a good sign. And then I can't remember if it was last night or the night before, China's repo operations were, just absolutely massive. I'll throw a chart up of that if I can find it here. And so all across the financial system, you're seeing these massive signs of stress, tension, and weakness, and these central banks and the governments are responding with emergency action, and it's not working, because the problems run much deeper than the coronavirus. They're financial system problems, and we're likely to see that this is kind of the start of everything starting to unravel here. Now, I want to talk for a moment about politics, because today, Super Tuesday, really interesting because over the last couple of months, it's looked like the Democratic Party was pushing Buttigieg, and I apologize if I'm saying his name wrong. I don't know how to say it, but it looked like they were pushing him. And I don't have any reference or source for this. Just something in my memory. I remember somebody telling me that they, read an article or saw something, like it was like a year or two ago, that the Democratic Party in particular decides years in advance, up to a decade in advance, who their frontrunners are going to be, who their nominees are going to be, and they just, they kind of have these things. It's not really, a democratic process. The establishment kind of decides what this is, who the people are going to be beforehand. Probably the Republican Party acted at least in the same way, or still tries to, but I think Trump kind of, smashed the Republican Party. They don't really exist in the way that they used to. It was like a year or two ago, they said, Biden is going to be our presidential nominee for 2020. And again, I don't have any sources for this, so I might be completely wrong about this. But I was thinking about it like a month ago because it looked like Buttigieg was going to be the person they were pushing. And I was like, yeah, well, that must have not been true. But within the last couple of days, if you've been following politics at all, Buttigieg fell out of the race. He dropped his bid. And Klobuchar, same. And those were some of the more centrist figures that were, thinking, hey, if these people, they might have a chance because they're not going to ostracize people who just don't want straight up socialism at risk in our country. And so, but they dropped out. And they're supporting Biden now. And the funny part is, I don't know if it's true, but it looks like they were told to drop out. And the same, influencing influencers that told them to drop out, told Elizabeth Warren to stay in because she's splitting the votes from Bernie Sanders. So anybody who's on the really far left is kind of split between Bernie Sanders and Elizabeth Warren, and so they just told her, you need to stay in because we need to give all of the center left votes to Biden, and any votes that are left over for the far left need to be split between Bernie Sanders and Elizabeth Warren, because if she drops out, those are all going to go to Sanders most likely instead of coming over to Biden. And so looks like it's kind of unfolding that way. And so it'll be really interesting to see what happens tonight. I'm going to be excited either way. It should be interesting. If Bernie Sanders somehow pulls this off, that'll be I would imagine it's going to be pretty bad for the market. I'd imagine there's going to be a big sell-off, because then the chances of him actually winning the election in November, jump up a lot. And so we'll see what happens. It'll be interesting, but it looks like the Democratic Party might pull it off, sidelining Bernie Sanders once again and throwing Biden in the ring, like apparently it was their plan all along. So don't put too much weight in that. Just thought it was a very interesting story that might or might not be true. Kind of looks like it might be. So I just wanted to share that with you. Keep your eyes open. Keep your hedges on. Over the last couple of months, I've been telling you guys, make sure you're hedged. If you're in domestic equities, make sure you're in something like a hedged equity fund, or there's ETFs out there that they're hedged, so they buy puts. And they're long equities, but they're long short, so they buy equities, but they also buy puts, or they have some sort of short mechanism in there as well, just to make sure that when there's a big sell-off, that they don't get the brunt of it. Make sure that you're doing at least something similar, and protecting yourself. It's far better to be protected against the massive sell-offs than it is to worry about the small cost of being protected, because in the event that you need that, fire insurance, it's going to pay off, and so you're not going to have your portfolio get burned. And ultimately, the valuations in the stock market, they're still basically at all-time highs. We're not anywhere near what I would consider to be stocks being on sale, or at least at levels that seemed normal. Historically, the total market cap to GDP is still at basically record levels. The S&P 500 price to sales ratio still at record levels. Profits, earnings still declining, especially right now with the coronavirus coming out. We'll see what that does over the next couple of months, couple quarters. And ultimately, stocks haven't sold off that much. And so to me, domestic equities do not look like a buy the dip. If you're going to try and buy the dip in stocks, I'm looking a little bit at Asia right now, because they've had the brunt of the coronavirus right now, and from a macro perspective, from a long-term perspective, I'm a lot more bullish on Asia than I am on America right now, just because, even in like Japan, like there's places that they're, the cultures, operate fundamentally different than ours does, which is a lot more heavily leaned on being consumers, built on debt. Whereas over there, they like in India and China, they're the biggest buyers of gold. And so just all their citizens, they all have a lot of gold and savings, and they're not consumers, they're producers. And so long term, from a macro perspective, I'm a lot more bullish, but right now we'll see how things unfold. And so it looks like the fire, if there's a wildfire going through a forest, kind of the safest place to be is where the fire has just passed through, right? There's no more fuel left to be burned. And so, well, from an economic perspective and from a health perspective, very soon here, the safest place to be in the world from the coronavirus will probably be somewhere like China, because it's already spread through there, and it's it's not at its peak. It's not like a wildfire at its peak right now. And so the worst place to be is where there's the most kindling, the most tinder, right? So from an economic perspective too, that seems like that might be the case. They've gotten hit pretty hard, especially things like airlines and tourism. So we'll see. This is going to have knock-on effects for a long time, and I think this is kind of I really do think this could be the pivot point, the hinge, the catalyst, the trigger that sends things spiraling down, especially since the Fed cut rates today. This emergency action meant to smooth out the markets, and it's not working. They're closing red. At least right now, they're down a little over 1% right now. So we'll see what happens. Stay tuned. If you want more of a play-by-play, frequent updates on what's going on in the markets, follow me on Twitter. It's at Heresy Financial. I'll link it in the description below. Thank you guys for watching. You guys have a great day.